Markets which appreciate in value over long periods are called cyclical bull markets. It's probably fair to say that the world is currently not favourable for a cyclical bull market to take effect, but there are investment opportunities, especially in equities right now. How should investors make use of these? A very good evening to you, gentlemen. Let's start off with you, Adrian. First off, your description of the world and classifying it in two parts, Sinfu and Paftoti. What exactly does that mean?
So we think that there are some core drivers or structural factors that explain the long-run socio-economic trajectory of an economy or of a country. And the way that we see the world is that there are essentially two rafts at the moment. And on the one raft is a cluster of countries that are very sick, that in the key factors that really matter to healthy long-run socio-economic welfare, they are poor. And it's ironic that it's the rich countries that are overwhelmingly poor. And then there's a second very rich, heavily populated raft of countries that are abundant in these six factors. And it's these economies and countries that we think are really going to shape the landscape for the foreseeable future.
Kobie, how do you see this playing out in the markets right now? Because of course we've had a lot of turmoil on the markets, a lot of uncertainty as to where markets are going from here, given what's taking place in Europe right now. So how have we seen developed versus developing world markets perform in light of that?
Yeah, so Samantha, I mean, you go back 3 or 4 months ago, it looked like markets were recovering beautifully. And then all of a sudden in May, we just saw this literal sell down in markets. We have a graph that I'd like to potentially show you at the moment. It stipulates specifically the British market in blue relative to the American market in red. And you can see that major sell down in the markets over there as the Greek crisis kind of continues to take center stage. And that becomes really, really difficult managing money from an asset management perspective. So again, we're kind of looking at those two rafts that Adrian was speaking about just now, and just the difficulty with kind of trying to understand, how do you make sense of this from an investment perspective? Because quite frankly, just kind of buying stock and just kind of letting it be and kind of just letting it run over time becomes very, very difficult.
So we're looking at two parts of the world right now, Adrian. You've got the wealthier countries right now, which are said to be poor in the socio-economic factors which are going to drive growth going forward. We've got those 6 factors. Let's run through some of them, starting with savings. Why are savings so important to look at from a long-term investment perspective?
Sure, Samantha, the only way in which you can fund investment, which is a critical anchor to economic growth, is from someone's savings. Either you've saved money out of your profit or your income, you've retained some profit or income, and you then apply that retained profit income to investment, or if you don't have your own savings, you go and borrow someone else's savings. In either case, the only way in which you can fund investment is through savings. And access to savings is the first critical component. The second is that those savings are then applied effectively, that you have effective application of savings.
Does this bring government policy into bear, and important what government is doing from a macro level with their savings?
Certainly. So is government a contributor to savings is the first question, and in most parts of the world they aren't. They're running very large budget deficits. So you have negative savings from government. That means either households or companies need to be saving, and overwhelmingly around the world, it's companies that are contributing to savings pools. So I think that's an element of it. But with regard to government, a second key factor in terms of the health of nations is that government policy is firmly established, clearly articulated, and applied consistently and diligently. First, you must have access to savings that you can then invest effectively, but that those investments take place in a stable policy environment. And the policy environment manifests itself also in stable institutions, like a stable South African Reserve Bank or a stable Monetary Policy Committee.
There are also factors that are outside of the control of the government, for example, demographics of the actual population. And for example, in the United States, an aging population there. Kobie, what are your thoughts on how what implications that has further down the line in terms of growth?
Well, let's look at some visuals, Samantha, regarding these PAF-TOTI kind of countries. That means kind of big Western countries that have kind of gone post-growth and have just got these big aging kind of populations. We've got a graph for you, and have a look at that over there. You can see the average life expectancy in years, and that's in the green bars, and you can see how those are kind of taken off relative to the average retirement age in years. And you can see the gap between the two are literally just opening up and opening up and opening up. That's in essence why more and more folk in kind of the Western world need kind of post-care. Post-care costs money. They're not necessarily that economically active than people that are in their 30s and 40s and so forth. Let me show you potentially another graph on PAF-TOTI type countries. And there you can see Japan, United States, Euro area, and UK. And here, GDP per capita has been, or GDP share, rather say, has been rebased to 100. And you can see the growth for these countries. I mean, there's nothing to kind of write home about. And the question is, where's growth going to come from? What is it that these countries are going to be doing in order to kind of grow going forward? Very, very difficult.
And as the population ages, the expense of healthcare becomes exorbitant, and then you have to also then factor in the healthcare sector as it stands and whether it's able to manage and look after the aging population and potentially more sick population. So that is also another key factor one has to look at.
I think that's critical, Samantha. And here, if you take two extreme cases, the one is China, where families save 50% of income. And they do that because they don't have a well-established, well-defined healthcare system. There aren't unemployment benefits or unemployment insurance. So if you get in trouble, you're on your own. As a result, there is this huge vault of saved income, which will be applied later. And if you do get sick or become unemployed or need pension funding, you've provided it yourself. On the other side of the equation, we've got the United States, and the prescription drug benefit alone that has been committed by US government is $20 trillion. That's the prescription drug benefit on its own. That commitment is larger than the entire US economy. And here, I don't want to be downbeat or cynical, because this in many ways evidences extraordinary scientific medical advance, that people are able to have these wonderful life expectancies, that they will live for a very long time healthy. But on the other hand, it hasn't been provided for. And the provider here becomes the state in the final analysis.
And can the state bear the burden when it has so many other burdens to bear at this point?
Exactly. And this is our observation about the PAF-TOTI scenario, is that the commitment on the part of the state is just way beyond what they can afford. They've committed to a luxury that they don't have access to.
Another key element is education, and of course, because that makes a more productive labour force down the line, a healthier labour force down the line. So that's a factor that one has to take into account. Would you describe the SINFU economies as ones that have high education levels?
Health and education are critical in every economy. If you go to the advanced world, you see very good education and you see superb healthcare, as the last point I think illustrates, with these long life expectancies. But increasingly, when you go to the SINFU countries, what you see is more and more evidence of effective education and improving healthcare. Now, this is not a Harvard Business School or Cleveland Clinic type education or healthcare in the first instance, but it's getting people onto the education ladder and onto the healthcare ladder, and with time they bootstrap themselves. So this is ever improving education and healthcare.
I mean, I think you guys have been quite negative up to now, because quite frankly you can understand why. But I think let's maybe try and focus maybe kind of on those SINFU countries. Let's try and understand a little bit more around kind of those countries that are kind of fast growing. Have a look at your screen right now and you'll see the GDP again. It's the same chart I showed you a little bit earlier on. But this now shows you for China, India, Nigeria, and Philippines. And you can see it's rebased to 100 again in 2007. And you can kind of see the growth, a very, very different scenario to what you saw previously. Let me maybe show you a different visual again here. And here you can see the income per person, or income per capita, across some of the very fast-growing emerging economies that you're seeing on that side over there. And there you can see the population, 4 billion individuals. And you can see this is where the growth is going to kind of come from. And if you're going to be investing, you need to kind of understand it from this perspective. I mean, is that not true, Adrian? How do you, and the other issue that you've probably got at play at the moment is if you look at the emerging world, it's not priced for opportunity. It's not like it's cheap relative to what you're buying in the Western world, which kind of makes investment in these kind of economies very, very difficult. But it's got the right mechanisms. You spoke about those 6 factors earlier on. It's got all of those. How do you invest in those?
Yeah, so Kobie, there's a range of points here. The first is, if I can just go back one step, and that is to say that in that lineup of the SINFU countries, there are 4 billion people. We don't imagine that every single one of those economies is going to thrive and succeed. There will be some disasters, and there may be some on that list that haven't yet shown their true colours. But you only need a 1 in 4 success rate, and you've replaced the entire advanced world. In terms of how do you invest for that then, this is the real challenge, because what markets typically do is they price based on the sentiment. And the sentiment is, in the SINFU countries, there's fast economic growth. Socioeconomically, they're very well positioned. But when you go and look at the market multiples, what you observe there is demanding, stretched market multiples. And the best way to make a bad investment is to pay too rich a price. So how do you access these opportunities is the key consideration. Equally, when you go and look at the advanced world, what we find again and again and again is that the advanced economy markets are priced on very low multiples. They're priced essentially for disaster. And this is the opportunity of investing, where you've got price and sentiment that step away from each other, or price and reality. So
you've got basically the world, perhaps, and the market very much in line with where growth is going to come from when it comes to pricing right now. But it's around paying a price to get capital appreciation further down the line. But just can we take it quickly a step back and look how South Africa fares within the whole SINFU scenario right now? How do you think South Africa scores with regards to those 6 factors? Because when I see factors like education, synchronicity of national policy, transparency with national policy, and healthcare, those just 3 stand out for me, and savings as well. Doesn't seem like South Africa should fit into this conundrum. Yeah,
so I think that's a really great observation. You know, where does South Africa fit in here, and your assessment of some of these different factors? When we weight these 6, or when we go through these 6 factors and look at the individual weights of the components, what we find is South Africa has sufficient weight, in other words, sufficient health, to actually make it onto this raft of what we call Division 1 and Division 2. South Africa is on Division 2 in the SINFU lineup. That means we are on balance healthy, but there's work to be done. If you look at some of the individual components, savings we're actually pretty rich in, and it happens to be that it's corporate savings, and I think there has been a lot of airtime given to this, that there's 500 billion odd rand sitting on corporate balance sheets. That is demonstration of healthy savings behavior. The aspect of policy and institutions, we would venture that policy and institutions on balance are robust in South Africa. And I alluded to some of those earlier, the MPC, South African Reserve Bank, we could add in Treasury, SARS, but there is some impeccable institutional infrastructure in South Africa. The 2 on which we, in my mind, without question fall down is education and healthcare. These are the 2 critical challenges to South Africa, not only staying on the second raft, but advancing to the first raft. One of the components that we didn't pick up on is openness, and on balance we find that open economies do really well. This is not just the movement of goods and services, it's also the movement of capital, ideas, people, and South Africa is open for business. Okay,
so if you want to get exposure to SINFU economies, you need to think of 4 things when it comes to investment implications. Run us through those, Kobie.
Yeah, I mean, look at your look at the graph at the moment. You'll see there's the 4 implications that you need to take into consideration when you're trying to get investments right. First one is asset allocation is the key. Get your asset allocation wrong. That means, in essence, your exposure between equities, bonds, cash, and property, and various of the other asset classes, and then also obviously across regions. Get real about yields, and hence that's basically the yield you can make out of the investment. That's dividends that we're talking about there. And then PAF-tarty assets, SINFU exposure. Those means assets listed specifically in older world economies, but that give you exposure to fast-growing economies. And then obviously the gift of sentiment, which is classically important to, for value-based investors. That means wait for markets to turn negative, and that's classically what's been happening now in May. I mean, those are the four things that I think you guys have kind of put together and kind of said that those are the things that are very important at this stage.
We think that those are front and center in investment decision making, and if you're going to worry about getting anything right in the world right now, those are the things to worry about. So in terms of asset allocation, not just which asset classes are you in, but in which countries do those asset classes reside? We think that whilst China, for instance, is a remarkable economic growth story, it's a very richly priced market. By contrast, there are equity markets that are not housed in fast-growing economies, but have exposure to those fast-growing economies. Spain is a case in point. Germany is another case in point. And in both cases, these markets are on very low, undemanding multiples. But if you look at both of those economies, they're essentially outward-focused economies. Most Spanish businesses are on the exchanges done outside of Spain. The same with Germany.
Yeah, and I suppose you could say a lot about the UK, that about the UK as well. There's some fantastically listed businesses there, or very, very decent multiples, and the dividend yields are literally shooting through the roof relative to emerging markets where the dividend yields are actually quite compressed.
Yeah, exactly. So there are a number of these advanced economies that give the same opportunity. That doesn't mean every single advanced economy is attractive, or that every single emerging market or dynamic market is overly priced. You need to go on a case-by-case basis.